Gentlemen, Warren Buffett has stepped down as the CEO of the legendary Berkshire Hathaway at the end of 2025. But before Buffett stepped down, he made a final investment for the company. And this is literally his last gift for investors, showing us how the most patient capital in the market is positioning. I went through all of Berkshire Hathaway's latest 13F filings, so you don't have to. And in this video, I'm going to show you Buffett's final quarter moves, what Berkshire bought, what it trimmed, and one massive brand new position he added that surprised almost everyone. Let's cut to the chase. Stock number 5 he bought is Chevron, CVX. Berkshire Hathaway increased its stake in Chevron by purchasing over 8 million shares, bringing their total holding to roughly 130 million shares. This investment was worth approximately $19.8 billion, marking a post-6.51% share increase in the quarter. Chevron is a classic Berkshire-style energy holding, global scale, upstream-downstream integration, and the kind of cash flow profile that can look very attractive when inflation is sticky. For Buffett, Chevron isn't just an energy play, it's a cash cow that allows him to collect a reliable 4.5% dividend yield, while the company simultaneously uses its excess billions to buy back its own shares, effectively increasing Berkshire's ownership stake without Buffett having to spend another dime. Beyond the financials, I think this move signals Buffett's long-term conviction that traditional energy remains indispensable to the global economy. By doubling down on Chevron alongside his massive stake in Occidental Petroleum, he is positioning Berkshire to profit from a higher-for-longer energy environment. He recognizes that while the green energy transition is happening, Chevron's massive scale and strategic assets, like the Permian Basin, provide a critical, high-margin bridge that will be necessary and highly profitable for decades to come. The key investor takeaway here is that Berkshire tends to like energy when it sees durable free cash flow and shareholder returns. A modest ad like this reads as still a core piece. Next one up, stock number 4 is Chubb, CB. Berkshire Hathaway purchased approximately 2.92 million additional shares of Chubb. This 9.3% increase brought Berkshire's total position to 34.3 million shares, valued at approximately $10.7 billion as of year-end. Chubb now represents roughly 3.9% of Berkshire's equity portfolio, making it the firm's 8th or 9th largest holding. I believe the most critical reason Buffett is buying Chubb is its elite underwriting discipline and moat among wealthy clients. While most insurers struggle to break even on premiums, Chubb consistently maintains a combined ratio below 90%, meaning it keeps over 0.1 in profit for every $1 collected. Its masterpiece brand dominates the high net worth market, where affluent customers are less price sensitive and value superior claim service. This gives Chubb rare pricing power and a steady stream of float, the interest-free capital Buffett loves to reinvest, making it a perfect mini Berkshire that generates reliable cash regardless of broader economic volatility. Furthermore, Buffett likely sees Chubb as a strategic hedge against inflation and a play on higher interest rates. Because Chubb holds a massive $130 billion investment portfolio, primarily in bonds, it directly benefits as older, lower-yielding bonds mature and are reinvested at today's higher rates. At a valuation of just 12 times earnings, Buffett is essentially acquiring a high-quality compounding machine at a fair price, while other sectors remain overvalued. In a world where markets swing between AI euphoria and panic, boring machines can quietly do damage. Adding to CB says, we still want high-quality compounding. Stock number 3 is Domino's Pizza, DPZ. Berkshire increased Domino's by about 12% to more than 3.3 million shares, with the stake valued around $1.4 billion. I believe the core reason for this aggressive accumulation is Domino's extraordinary asset-light business model. By franchising 99% of its 21,000-plus stores, the company collects high-margin royalties and supply chain fees, while franchisees bear the heavy costs of rent, labor, and maintenance. This structure creates a cash machine that generates predictable, recession-resistant income, exactly the kind of durable economic moat Buffett seeks, allowing the company to reward shareholders through a growing dividend and massive share buybacks that increase Berkshire's ownership without any extra effort. Beyond the financials, Buffett likely sees Domino's as a logistics and technology powerhouse disguised as a pizza chain. Unlike competitors who rely on expensive third-party delivery apps like DoorDash, Domino's owns its entire digital and delivery infrastructure, which protects its margins and deepens its brand loyalty. With the stock trading at an attractive forward PE of 19, a nearly 30% discount to its historical average, Buffett is essentially buying a dominant global brand at a rare sale price during a period of market-wide overvaluation. This kind of pick often signals something subtle. Berkshire sometimes likes businesses where the market is overly focused on short-term consumer fear, while the long-term machine keeps printing. Now here's a funny one. Stock number 2, Lamar Advertising, Lamar. Berkshire increased Lamar by just 300 shares, though following a more significant entry earlier in the year and ending around 1.2 million shares total. Lamar is a dominant leader in outdoor advertising with over 360,000 displays, enjoying high barriers to entry due to strict zoning laws and regulations that prevent competitors from simply building new billboards nearby. As a REIT, the company is legally required to return 90% of its taxable income to shareholders, providing Buffett with a substantial 4.7% dividend yield. This slow and steady cash generator aligns perfectly with his preference for durable, asset-heavy businesses that are less susceptible to the rapid technological disruption seen in digital or social media advertising. But before we talk about the last stock that is brand new to the Buffett portfolio, I want to have your attention on some of the stocks Buffett sold during his last quarter. The first stock he trimmed is Apple. Berkshire's Apple stake is still enormous, about 300 million shares, but Berkshire trimmed it by roughly 25% in the quarter. Second, when Buffett first bought Apple in 2016, it traded at a PE ratio in the low teens. By late 2025, that multiple had ballooned to over 33 times higher despite slowing revenue growth. By trimming the position at these historic highs, Buffett is essentially taking chips off the table to lock in massive gains, over 1,000% total return since 2016, while preventing a single stock from overly dominating Berkshire's risk profile. Second stock he sold is Bank of America, BAC. Trimmed, but still a top holding, Berkshire reported about 517.3 million shares of BAC and trimmed the position by around 15%. A trim here, to me, can simply reflect the reality that bank earnings can be more sensitive to the policy cycle than many investors want to admit. This reads more like position sizing than exit. Now, the largest trim, Amazon. Berkshire trimmed Amazon hard, about 2.28 million shares remaining, with a 77% share reduction shown in the quarter. I believe the most critical reason for this sale is a growing discomfort with Amazon's massive capital expenditure for AI. The company announced a staggering $200 billion spending plan for 2026, which is $50 billion higher than analyst expectations. For an investor like Buffett, who prioritizes businesses that generate immediate, predictable free cash flow, this AI arms race represents a high-risk gamble where billions must be reinvested today for an uncertain payoff tomorrow. Finally, here's the one I told you to wait for. Berkshire initiated a new position in the New York Times Company, NYT, about 5.07 million shares, worth roughly $352 million. Why is this interesting? Because NYT is not a traditional Berkshire headline pick. The most critical reason for this purchase is the company's successful evolution into a high-margin digital platform. While Buffett famously labeled most newspapers toast in 2019, he likely sees the New York Times as the rare survivor that has built an economic moat around its brand. The company is no longer just a newspaper. It is a digital powerhouse with over 12.7 million subscribers and diverse revenue streams from games, Wordle, cooking, and sports, The Athletic. This bundle strategy has created a sticky, recurring revenue model that generates massive free cash flow, approximately $551 million in 2025 alone, which is exactly the type of predictable business Buffett favors. Furthermore, the New York Times demonstrates the pricing power and capital discipline that are hallmarks of a Buffett investment. In 2025, the company grew its digital-only subscription revenue by 14% and digital advertising by 20%, all while increasing its dividend by 28% from 0.18 to 0.23 and maintaining a $1.2 billion cash reserve. Even at an aggressive forward PE ratio of 24, Buffett likely views it as a quality compounder that can maintain its authority and margins in an AI-fragmented media landscape. At the end, I want to say this. Although Buffett is the legend, don't just copy trade Berkshire line by line. A 13F is delayed, and Berkshire's time horizon is longer than most people's patience, and you want to use this to identify themes: cash flow durability, CVX, underwriting discipline, CB, repeatable unit economics, DPZ, real asset pricing power, LAMR, and subscription resilience, NYT. Thank you for watching, and please drop a like and subscribe if you find this content helpful.